Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Rob, it is wonderful to be back with you this week. I don't think we've spoken since before the summer, actually. So how are you? How are things in the UK?
Yeah, I've been on a very long summer break, as I'm very lucky to be in position to do so, and enjoying what was a very nice sunny summer in Britain and also a bit of Europe that I visited. And it's nice and sunny today, which is good, as we're obviously welcoming VIP visitors to the UK at the moment. But I won't mention the name of these people. But we like to be good hosts, so it's nice that they've got good weather.
Yeah, no, that is absolutely true. We got a good lineup of topics, as we always do, of course. We got 3 questions coming in, or that came in, I should say. Before we get into all of that, I was going to ask you, as I normally do, sort of what's been on your radar. And I imagine the last couple of weeks, not the whole summer holiday recap, but...
Yeah, I won't do the when I was a child at school, the first thing you always had to do when you came back in September was write an essay entitled "What I Did in My Summer Holidays." Because I've got quite a vivid imagination, I always felt the ability to make stuff up, which I hope amused my teachers immensely, rather than just reading about the normal standard stuff. It's actually an anniversary of an important event recently. And that is Lehman Day. So happy Lehman Day to those who celebrate. So 17 years to a couple of days ago, it was the sort of financial crisis, and I find it astonishing that it's been 17 years. It makes me feel incredibly old to say that, because it's still very fresh in my mind. But so if you follow the Financial Times Alphaville blog, which is free, by the way, unlike the rest of the FT that's behind an extraordinarily expensive paywall, as I know to my cost. They did an article last week, and they've got all kinds of sort of a treasure trove of historical documents that you can read about including I won't mention the name of the bank, but a note from a sell-side analyst saying that Lehman's is a great investment at this price, and you should definitely buy shares in them. That was written about 10 days before they went bust. Well,
let me be more precise, because I did look up the treasure trove then when you mentioned Lehman Brothers. And I will mention it's public knowledge. So, so apparently it's a note from Morgan Stanley. It's dated June 30th, and it initiates coverage of Lehman Brothers with an overweight recommendation. That is iterated apparently on July 14th and August 27th. Now, the lead author, here I will blank out the name. People can look it up if they want.
Yeah, let's not kick the nominees down.
He left Morgan Stanley in 2009 and joined the Congressional Oversight Panel for Market Monitoring, Regulation, and top management, and spent 5 years at the Treasury Department, where he was first executive director of the Financial Stability Oversight Council. I mean, you can't make this up, but it's...
I suppose you could argue that having, made mistakes in the private sector, he'd have learned valuable lessons that then the public sector could take advantage of in his new job. Let's be charitable about this. Everyone deserves a second chance, and everyone makes mistakes. So these things happen. But they do say that if you're a hedge fund manager and you've lost a lot of money, then actually people are desperate to give you money. because well, first of all, if people gave you a lot of money to begin with, then you must have some credibility. But secondly, they're like, well, you must have learned something from that, and hopefully it'll be much better in the future. So yeah.
Sometimes the world just seems upside down, frankly.
Yeah.
It's a little bit like George Costanza in Seinfeld. The opposite, kind of works, right? You lose money and then people line up to give you money. I mean, it doesn't work funny enough, in the CTA world, it doesn't seem to be the way the things work.
A sneak preview for some of the topics we'll talk about later is that will be one of the themes for today, definitely. Should you give money to people after they've lost money or not?
Okay, fair enough.
So, yeah.
Okay, all right. Well, I mean, on my radar, not that, it's not that I spend a lot of time looking for sensational stories, but even in the not so surprising rate cut we had yesterday from the Fed, the 25 basis points that everybody was expecting, there are a couple of things I thought was kind of interesting. One of the big headlines, of course, was that the new Fed governor, Stephen Moran, who was just sworn in, I think the day before, he dissented the decision. He wanted to go for 50 basis points. No surprise there. And I think even Powell dodged a question about Fed independence during the press conference because of Moran's presence on the FOMC. But one thing that actually also was kind of interesting, and that is that Christopher Waller, who I think is one of the contenders to be the next Fed chair, he did not dissent. So he actually was in line with the 25 basis points. Probably not something that necessarily the administration would have liked to have seen. So anyways, it'll be interesting to follow. It didn't sound like, from what I've read, that Powell was lining up, complete surrender and lots of rate cuts coming our way. So we'll have to follow it. The other thing, and this is not news, but it's something that I've noticed lately, is that I find it very interesting that some of these large institutions, the BlackRocks, the Fidelities, have entered the CTA trend following space lately. And actually, Fidelity put out a paper, I think in June, written by Roberto Croce and Sladja Carton, about the beautiful managed futures as a powerful portfolio diversifier. I don't think there was anything new. I will read you the conclusion, though, because they say in the paper, managed future strategies represent one of the most time-tested, research-backed, and structurally unique investment approaches available today. Their ability to dynamically respond to trends, maintain low correlation to traditional asset classes, and protect capital during crisis makes them a valuable component to both traditional and alternative investments. While they may not always outperform in every environment, we believe their consistent contribution to portfolio resilience over time justifies serious consideration by any investor seeking long-term risk-aware diversification. Now, that's all good. There's nothing new in that. These are all the arguments that we would otherwise have put out in the last couple of decades. What's interesting to me is, why now? Why are these huge institutions coming out with their products now? Because, as they say in this article, this is not new, so they must have known about it. So why didn't they launch these products 10, 15 years ago? Now, I know this could be personnel-driven. Maybe Roberto, I know I actually spoke to him at some point, so I know he's been working with Trend for a while, and obviously not necessarily at Fidelity, but also people like BlackRock and so on and so forth. It's just interesting. I think it's great news for the industry that some of these really heavyweights in our industry and gatekeepers of huge model portfolios, where most likely they're going to be using their own products to give people exposure to trends. So that's wonderful news. But it is kind of funny to me that it's all happening in 2025 and not sooner.
Yeah, actually, I had that article flagged as one for us to potentially discuss, but I'd assumed because it was quite old now that someone else would already have brought it up.
We haven't discussed it.
Yeah, so I did actually look at it. I think you're right in saying that there's nothing really new there. Like if you look at all the kind of graphs that they use, it's the very standard. It's almost like if you're someone who works for CTA and your job is to sell CTAs, you've got like a kind of classic deck that you use of graphs, right? So one is the correlation matrix. They've got a correlation matrix in there, to both equities, bonds, and also 60/40. One is the kind of like the sort of selective performance where you say, well, what happened during this GFC, which we've been talking about? What happens in 2022? What happens in and I think they've even gone back to 2002, the dot-com crisis as well.
.com is there, yeah.
Exactly, yeah. So that's a classic kind of thing to show, what in those situations, how did bonds do? How did equities do? How did 60/40 do? How did trend do? And they've also got the classic, what happens to, mean, standard deviation, drawdowns, and Sharpe ratio when you add, say, I think there's 10%. Yeah, when you put 10% of a 60/40 portfolio into trend, it does better. So yeah, it's the classic, the classic deck, and it's not particularly anything new, but you're right. The significance is that this is Fidelity, like that. Almost, one of the biggest asset managers in the world. You've basically got, you've got BlackRock, you've got Vanguard, you've got Fidelity, and I guess in terms of just sheer number of assets, PIMCO is probably up there as well, right? So we're talking about top 4, top 5 asset managers in the world, and they're suddenly interested in this. So yeah, it's curious. And it may just be a weird coincidence, or it may be because, and we'll get to this, it may be because, trend hasn't done so well recently, and who knows? Maybe this is buying the dip. We'll see.
Yeah, no, absolutely. And for those who may have missed, I think maybe it was not last week's episode, but the week before, I did mention the paper that the firm I work with, Dun & Capital, produced and released, and you can also find it in the latest Sunday newsletter that I publish if you're subscribed to that. And I think also I put a link to some, and I think it was like toptradersunplugged.com/high vol trend. I think this was the link. But in any event, we didn't spend time actually repeating all these arguments. We just looked at the evidence and we compared it to all the major hedge fund strategies because we hadn't seen that being done before. So if people is interested to see how our industry versus quote unquote hedge fund strategies have done, then they can look that up in the paper. We've already touched a little bit on managed futures, so let me just get into that now. My own trend barometer finished yesterday at 41, so that's an improvement. Still not very strong, I have to say, but it's an improvement in the last 10 days or so. And, so far, September, although the last couple of days leading into the Fed cut and the Fed cut itself has not been great. I see performance down a little bit the last couple of days, but it's still a positive month. And some of the kind of, how should I say, usual suspects from the last couple of months, such as equity, such as gold, have been really pulling the performance forward. And so we see a continuation of that. In terms of hard numbers, let me find them here. Beta 50 is, as of Tuesday this week, up 2.43% for the month, now down only 45 basis points for the year. So a great comeback. SocGen CTA index up 2.85 for the month, down only 3.62% for the year. SocGen trend up almost 4%, down only 4% and change for the year. And the short-term traders index, actually a good improvement, 2.13% for the month, down just 4.37% so far this year. Now, of course, the traditional world continues to deliver. MSCI World up another 2.2% in September, now up 16.6% for the year. The US aggregate bond index from S&P is up 1.25% for the month, up 6.25% for the year. And the S&P 500 total return index up 2.25% for the month and up 13.29% so far this year. Not necessarily specifically about your, what are your takeaways from trend, looking at your own kind of way of dealing with these signals this year over the summer? I imagine you've also seen some improvement over the summer.
Yeah, actually, unfortunately, my computer is temporarily broken. So
that's fine. Just talk about from what you remember, Rob.
Yeah, it's fine. Yes, I can't give you P&L numbers. I can give you risk numbers though. So that's telling you like
just
where
give
I'm
me
positioned.
your thoughts.
Yeah. So last time I checked, I was kind of making some positive performance. I'm not sure whether I'm flat for the year as quite yet. But not too far off, hopefully. So I'm currently long equities, long FX, long bonds. So I'm quite a little bit short energy. So that's kind of the overall pattern, and risk is running at, I guess equivalent numbers to you really. So like it would be about 50 or 60% of my kind of typical kind of risk level. So still not putting on like massive positions. It doesn't look like there's still very clear trends out there, it looks like I'm short Bitcoin now, so that's nice to see. I do like it when my system agrees with my own prejudices and biases. So that's a nice, pleasant sight. But yeah, I mean, it does feel like a kind of, it does feel like the market is although the traditional markets are doing very well, it does feel like there's an awful lot of bad news out there that isn't, to me, priced in. I mean, particularly in interest rates. I mean, in any other kind of universe, the fact that Fed independence is being seriously threatened, as you mentioned, should be something for to cause serious consternation. I mean, all right, so where am I with bonds? Hang on.
I think while you've looked that up, I think, and I may have mentioned it last week, I think right now in the CTA space, bonds is where there might be some divergence in positioning, because I see the daily moves between some of these ETFs and mutual funds, and it almost feels like that when bonds go up, some managers, do much better than others, and so on and so forth. So I think maybe bonds people or models just disagree on. I think equities and gold and silver and all of that stuff, people are fully aligned.
Yeah,
really.
I mean, one reason for that might be that, carry is a much more significant factor in bond price movements than it is in equities. And so the weight you have to carry will make quite a big difference to your positions versus trend. But yeah, for what it's worth, I'm long bonds, but my risk is about half what it is in equities. So I'm long, BTPs, I'm long, which is the Italian 10-year, obviously. I'm long US 30 years, I'm long 10-year Canadian. So yeah, I basically have a sort of modest size, but consistently long position in bonds. So, if there are serious concerns about Fed independence and inflation, then unfortunately if I'm right in the sense of my kind of gut feeling that, Trump is bad for the bond markets, then and bad for the equity markets, then at least in my systematic portfolio, I'm going to lose money. So there you go. That's life.
A fair point, but actually, it's not just about one individual. I think with the fiscal policies being implemented right now and everybody getting into massive amount of debt, I think you could probably argue that many bond markets might, probably should have a higher risk premium than what they have.
Yeah, but
right
I mean,
now.
the bond market selling off with debt concerns is the dog that's never barked, really, to be honest. I mean, apart from, Liz Truss a few years ago, politicians in developed markets, generally speaking, get away with levels of debt that a few years ago people thought would be inconceivable.
Yeah, you say that, fair enough, and that's not
Emerging
really the topic
markets,
of today. But
yeah.
But in the UK, we did hit 27-year high yields only a couple of weeks ago, higher than when Liz Truss. So maybe someone in there are actually aligning with your thoughts that this is not a great idea.
We also have persistently high inflation. I mean, we've sort of maintained quite a bit of inflation from 2022, whereas in say in the EU, it's kind of mean reverted a fair bit. But yeah, I mean, if you look at the spread to bonds, it's pretty, or even actually PTPs. I mean, it's you're better off lending to the Italian government than the British government, apparently. But that doesn't work with the debt story, right? Because Italian debt to GDP ratios are much worse than the UK, so it can't just be a debt story. It must be an inflation story. So
and the whole inflation story. I mean, depending on which country and how they measure inflation, it's very hard to get.
Anyway, let's stop pretending to be macroeconomists and experts on this, because people will think they've tuned into the wrong podcast. So.
Let's move on to the questions.
Let's move on to things that we actually know about. Yeah.
question number 1 from John came in a few days ago. Hey Rob, big reader and implementer of your work. My question is about adapting your continuous forecast-based position sizing for a cash-only portfolio like stocks or crypto, where total notional exposure cannot exceed 100% of capital. The formula correctly scales a position based on forecast strength. A forecast of 20 would target double the exposure of an average forecast of 10. When the sum of these ideal positions across all instruments exceeds available capital, what's the best way to scale them down? Should all positions be reduced proportionally to meet the 100% capital limit? Or is there another method you would recommend for managing the excess signal?
This is a really good question. Actually, it's extremely relevant because I'm currently writing a book about trading without leverage. So there's my book plug for the day. Niels, you can take that off the list.
Is that a promise?
Yeah. Well, unless there's another question related to it, in which case, sorry. So yeah, I mean, so obviously if you can't increase your position size when you get more confident about your positions, then you've kind of got two options really. So one is to kind of just effectively cut everything in half. And what that would mean in practice is that your average investment would be 50% cash, on average you'll be using 50% of your exposure. And then if your forecasts are really strong, you'll be up to 100%. And the problem with that is that it depends on what you're trading, right? So if you're trading very, very liquid, very illiquid, risky emerging market stocks that have say an annualized standard deviation of like 50%, then actually trading with half of that on average, which would be 25%, ignoring diversification effects, wouldn't necessarily be a bad thing. That would be a reasonable risk target to run like 25%. That's what I run myself. On the other hand, if you're trading, say, like liquid, large cap S&P 500 stocks, then, which have an annualized standard deviation of like, say 25, 30%, then, you're going to be going down from some, say 25 to 12.5%, which is a very low risk target and is unlikely to be optimal. So you could make more, what you do in practice is you just have to say, well, I'm going to live with the fact that I can't use forecast strength in such a clean way to actually construct my signals. So if my forecasts become really weak, then yes, I will cut my position. But if they get stronger than average, then I can't really do anything about it. I just have to live with it. So what I would probably do is something like, rather than cutting, at the moment, I cut my forecasts off at 20, which is twice the average. I'd probably cut them off at 10, which is the average. And what that would mean in practice is that if you had instruments you were holding where you had less than the average forecast, then you'd have a smaller position in them. So you basically would have cash creeping back into your portfolio. The question then is whether it's then optimal to reallocate that cash to other positions. Then it gets complicated. So in theory, yes. In practice, unless it was a big effect, I probably wouldn't bother because it would get a bit too complicated. And yeah, for more details,
yeah,
buy the book.
There is a book out there somewhere.
Yeah, there probably is another book, but specifically for this problem, I'll definitely answer that question for you, but you just have to wait a few months, I'm afraid.
Okay, cool, great. All right, well, there is another question. This is from Absolute Gnosis, which I imagine is some kind of handle.
I mean, it could be their real name.
It could be their real name. And I will just stress that I normally would only take questions that comes from people with a real name, just so people are aware of that. Anyways, the question is short/long symmetry optimal for a strategy in which the price of the traded instruments is measured in units, quote unquote, fiat currencies, that are inflated, brackets devalued, at 8 to 14% per year? It's a very specific question. Maybe you can make more sense of it than I can.
Okay, so we obviously have someone who's a fan of crypto here because they're using the term fiat currency, and that term is never used except pejoratively by crypto people, right? So until about 5 years ago, I thought that fiat currency was the money you handed over when you went to buy a small Italian car. But no, when they say that, they mean traditional currencies like pounds, euros, dollars, etc. Now, I would be curious where they got this figure of 8 to 14% a year, because as far as I'm aware, there's no major economy where inflation's running at that level. But when I say major, I mean developed market, or whether that is what they think is the long run appreciation of Bitcoin versus, fiat currencies. Again, I don't know. Bitcoin's gone up by more than that recently, so I don't know if figures come from there. But anyway, so let's reframe the question to terms that make more sense, I think. And that's the following. Let's suppose that I'm trading a currency that's not, an instrument that's not denominated in my home currency. So for example, I could be a UK investor, as I am. I'm trading S&P 500 futures, which I am, which are denominated in US dollars. Okay. Now, let's also assume for the moment that I'm trading the cash instrument and not the future, because it gets a bit different with futures. But let's just for the moment assume I want to buy a US listed ETF that's denominated in dollars with my British pounds. And I want to say, well, I want to do some kind of trend following on that thing. So I need the price of that thing. Okay. The question is, which price should I use? Should I use the dollar price? So I just get the dollar price and I plot it on a chart, and I have a wiggly line, and I apply my moving averages or my Bollinger Bands or whatever it is I'm using to measure trends. Or should I convert that price into a pound sterling price? So I get the wiggly line and then I multiply it by the cable the GBP USD FX rate to get a sterling price, which obviously is going to look different. So to kind of return to the terms used in the question, if, for example, the pound had depreciated against the dollar, then the trend on that ETF would look stronger, okay, because it would have had a sort of systematic drift added to it, which is the depreciation of the currency effect on top of it. And that would make me more likely to want to buy that. Okay, so the question is, should we do that? And the answer is, well, if you do that, you're essentially trend following two things: an exchange rate and a currency, and you're kind of munging them into one thing, and you're trend following that thing together rather than trend following them separately. Because another equivalent way of doing it would be to trend follow the dollar price, but also then simultaneously have another trend following model which looks at GBP USD. Now, generally speaking, diversification is better than less diversification. By adding those two things together and creating the pound version of the S&P ETF price, what you're essentially doing is removing the potential for diversifying across two instruments, a currency and a stock market index, and just having a single instrument. Now, that will work if and only if trend following will work better on the combined thing than on the two things separately, which will have a diversification benefit. Now, I haven't checked this, but generally speaking, I'm a big believer of the fact that it's quite hard to pick out statistically significant differences in performance of trend following of different instruments. So, you can't, when people say, oh yes, everyone knows that X trends better than Y, my first response is, okay, what's the evidence? And they'll say, oh, look at here you go. And I say, well, if I put these two return distributions on top of each other and do a statistical test, I find there's no difference between them. So go away and come back to me when you've got a better idea. And yes, if you check 250 different instruments, then yeah, you will find a few that are statistically significant, but that's just because you've checked so many. Then that's just the way that statistics work. So you always find one or two by chance. So as a rule, I would not do that. I would not combine those two things together. I trade them separately. Now, things are more complicated when you think about futures, because in futures, if I'm trading and I want to buy an SPY ETF, say, I don't actually have to convert the entire notional value of my pound account into dollars to buy that. I just have to convert enough for the margin. And if the margin is, say, I don't know, 20% or 25% or whatever, which is kind of, roughly sort of average futures margin tends to come in at that, then my exposure to the currency risk is only a quarter of what it would be otherwise. Of course, because I'm trading futures, I can then separately go and trade the currencies as a separate thing and get the diversification benefit. So if you reframe the question as, should we currency convert price series before trend following, my answer is no. I don't think you should do that, because you're kind of muddling two things together. And actually, if you're also trading GBP USD as well as the currency converted SPY, the correlation between those two things will increase significantly, and you lose all the diversification benefits essentially. If you map that back to the original question, then I would say no. I wouldn't, for example, reconvert all prices into Bitcoin prices before running trend following things over them. Although, as I said, the whole premise of the question and the number in it, the 14%, I don't really know where that comes from. So,
no, that's fair. That's fair. All right, last question. We'll make it quick because we've got all your wonderful topics to get to. This is a question that came in from Lynn just a few minutes ago before we started recording. I'm going to read all of the questions, and then you can just quickly answer the ones that you may be able to answer. Lynn simply writes, I've tested a few strategies, but they're not working well with crypto. Got any ideas? ? I think that's a pretty open question. Then there is one, is your new book about cryptocurrencies? ? Are you considering a themed focus on stock picking?
So for the first question, I do know at least one person who's an Australian guy who's very active on X, who has made an awful lot of money using trend following on cryptocurrencies. So, you might, and certainly I've also myself, I have this sort of side hustle where I do a bit of consultancy for a crypto hedge fund. I've also tested trend following on cryptocurrencies, and it seems to work fine. And this hedge fund, again, is doing very well trend following cryptocurrencies. So trend following on cryptocurrencies seems to work pretty well. There's no guarantee, of course, about the future, but there we go. Yes, sorry about the second book plug, Niels, but it was forced to me through the question. But yeah, there is the book I'm currently writing is about trading without leverage, and that includes trading cryptocurrency without leverage. So it's in there. It's also about trading individual equities. So you can call that stock picking if you like as well. So there we go.
Okay, cool.
Something for everybody there.
Now, I'm excited about the next few topics that you brought along, although we kind of exchanged ideas fairly late this time around. So I will leave it up to you to guide us through, because there are a few different articles that you're sort of combining into a bigger theme that we can then relate back to also to our world of trend following. So I really need to just give you the floor, and we'll see where we go.
Yeah, so it's always hard for me coming back from summer holidays because I've not thought about, markets or trend following or anything for, the best part of 2 months. It's quite hard for me to get my head back into, like what's going on. So yeah, apologies for it all being a bit last minute, but yeah, so there's a few articles that kind of piqued my fancy, and I realized there was a bit of a theme to them, and then there was something else that happened that kind of tied into it. Anyway, so the first article I'm going to mention is on Jeffrey Tack's. So I think that's how you pronounce it. It's P-Tack is how it's written. I don't know if the P's silent.
Okay.
Jeffrey, apologies if Niels or I have got it wrong, but we've said it differently, so one of us bound to be correct. The article's titled "Wish I Was Making This Up," and the headline says it all. An ETF gains 42% a year; its investors still lose money. Now, it's perhaps not worth talking about the ETF itself in detail. For what it's worth, it's called the Yield Max Coin Option Income Strategy. So that's going to be some kind of ETF that is selling volatility to gain income. That may in turn have its own risks, but that's not really the point. The point is the thing did make money, 42%, jolly good. But the investors in it lost money. Now, how, you may ask, is this possible? Let's think about a really simple example. Let's imagine a fund that does something really strange. For 364 days of the year, it loses 1%. And on the last, so that's a total. Actually, that's not mathematically possible.
That's probably not.
Well, it is.
Possible.
It is actually if you have geometric losses. But let's change the math slightly. So for 51 weeks of the year, it loses 1%. So it's down basically half, pretty much. And on the last day of the year, it makes 200%. So that's a doubling and then another doubling. The first doubling removes the original loss. So basically, over the year, it's made 100%. Woohoo, brilliant, fantastic. Now, let's imagine 3 investors. The first investor is buy and hold, buys the fund beginning of the year, holds it till the end of the year, makes 100%. They're a very happy person, okay? The other 2 investors think that they're geniuses at market timing. So the first one buys the fund at the beginning of the year. After about 40 weeks, they just go, oh my God, this is ridiculous. I've lost 40% on this thing. Why am I still holding on to this piece of absolute garbage? And they basically sell it and then just sit in cash the rest of the year. So they lose 40%. The final investor has some kind of God-given talent for timing, and they wait till the very last week of the year, and they buy into the fund, and they make, a couple of 100%, maybe minus 1%. So they double their money, quadruple their money. Sorry. So they're even happier person. So that's 3 investors, and out of those 3 investors, only one of them's actually managed to match the return of the fund over the year. The other 2 have quite different returns. One's down 40%, the other one's up 200%. So we've got very different return profiles. So obviously that's a kind of made up and extreme example, but hopefully you can see that it's going to be impossible for any individual investor to actually earn the returns of a fund unless they literally buy and hold the whole time and make no kind of withdrawals or additional income. All of the investors will receive a slightly different return. So we'll call those returns the percentage return and the cash return. Okay, so percentage return is the headline amount the fund makes over the year, and the cash return is the money that any individual investor makes in it. But we can actually create an aggregate cash return because we can basically look at all the individual investors together and add up all of their, with withdrawals and so on and so forth, and work out how much they actually made in that year. So, for example, you could hopefully see that if 99% of the investors in the fund were of type 2, in other words, they held for 40 weeks and then sold, and only 1% of the investors was of type 3, in other words, they were the lucky person at the end, then overall, the cash return on that fund for all investors aggregated is going to be of the order of 39%, minus 39%. It's going to be minus 40%, plus a little bit for the guy at the end who was really lucky. So that's exactly what Jeffrey does. We'll stick to his first name because I think we can agree that it's a lot easier to pronounce Jeffrey. He looks at the annual reports and the kind of cash movements and looks at the net flows in and out. And the issue is that a lot more people are putting money in just before the thing goes down than are putting money in when it's about to go up, and vice versa. So they're taking money out before gains and vice versa. So yeah, as the net result of that is that they do not make 42%.
Specifically, according to his accounting, he says that $2.5 billion were coming in net inflows.
Yeah.
But the investors lost a combined $35.5 million over the very same period.
Yeah.
I mean, that's extraordinary.
Yeah. Well, I mean, so that's not a big percentage, but it's still a loss. So was it 2.5 billion and 35 million, did you say?
That's what the number said in the article.
So that's like a loss of 1.5%, isn't it? Yeah. So obviously a 1.5% loss is very different from a 42% gain. And this is going to be more problematic in funds whose returns are very, let's say, patchy or spiky, or to be technical for a second, that exhibit strong negative or positive skew. It's the fund I described earlier that loses money for 51 weeks and makes a massive gain. That's a kind of extreme example of a positive skewed strategy. Whereas something like trend following, for example, is a less extreme example of a positive skewed strategy. Selling option vol, as in the fund that Jeffrey describes, is generally speaking a negative skewed strategy. So it's got the opposite pattern, that again it's going to have a pattern of big gains, lots of small gains and then big losses. That's kind of, roughly speaking, what you expect to see. It's a bit more slightly different from that for this fund, because obviously it's not purely option selling. But again, if you're selling immediately before one of those big losses, you're going to do very well. But if you're buying before one of those big losses, you're going to, on the back of what probably look like persistent gains in the past, you're going to do very badly. So that's the first article. So a question, I think whenever you see an example of something happening, anecdote, as a kind of systematic person, right, as a quant, if you like, you should say, well, is this generally true? Or is this just, are the investors in this particular fund just uniquely stupid? Okay. So there was a nice piece of work done by, I think it's Morningstar.
Jeffrey Petak.
And it's Jeffrey again.
It's
Jeffrey
the same guy.
He clearly
so now we know he works at Morningstar.
We know he works at Morningstar. We still don't know how to pronounce his name, but we know he works at Morningstar, and we know that he has a thing about this difference between percentage return and cash return or investor return. So in this piece of analysis, he looks at all US investment funds. So I guess that's basically mutual funds, right? It's not hedge funds, it's mutual funds. So stuff that ordinary people buy and sell. And he looks at the difference between the investor return and the cash return over those funds. Basically, in this context, a negative number means that the investors underperformed the fund, if you like. So the previous example, that number would be like minus 40-something%, because it's obviously a massive difference. In my stylized example, it would be even bigger than that, right? So the numbers here aren't as big, which is kind of what you'd expect, because this is an average across the whole industry. And obviously in some, just in some funds, people will do better than the fund because their timing happens to have been good. There's probably no skill here. It probably just that by luck, there are so many funds out there, but in at least some of them, the investors would have got lucky. But so it's an average. The numbers are going to be smaller than for any individual fund, but they're still pretty damn impressive, to be honest. So if we look at the worst, for example, which is called equity, so that's kind of I guess US equities, although there's this confusingly sector equity. Apologies. So that will be something like a fund that has a thematic focus on, say, oil firms or tech or something like that. There the underperformance is 4.4% a year, which whilst is not 40% a year. If you're going to underperform by 4.4% of the year, consists for, and this is over 10 years, that's a pretty depressing long underperformance, right? Most people in a situation where they were underperforming by an average of 4.4% a year for 10 years would not be in a job for much longer. And I guess, and that's the biggest figure, but if you look at the whole universe of funds, the underperformance is 1.7% a year, which may not sound much, but again, over 10 years, that is a significant difference. And if you do a little maths and see the effect on compounded returns over 10 years with the 1.7% underperformance, you're going to see a pretty substantial underperformance. And I guess if I was to kind of do some speculative thought on this, I think the reason why it's particularly bad in equity sectors is that's where I think people are going to be most affected by kind of news and emotion and stuff, and things like, oh, the AI revolution is coming, let's put all our money in AI, and all the AI stocks have already gone up a lot, so then they go down and it turns out to be spectacularly poor timing. So generally speaking, people are quite poor at predicting quite poor at predicting the future, full stop. Otherwise we'd all be gazillionaires, but they're quite poor at predicting whether a particular fund or a particular manager, if you like, is going to do better in the near future. So they're very poor at timing when to invest in things and when to take money out of things. That's the conclusion of Jeffrey's work, I would say. So yeah, I found those articles interesting.
Yeah, and it kind of ties into a third article from the FT where they are kind of rebutting an article that was originally posted in Investment Advisor Association. And I think it's called Debunking the Persistence Scorecard.
Yeah, I mean, this is interesting. I'd never heard of the persistence scorecard, and maybe
neither me.
No, maybe that's because I'm not a regular reader of, of that particular. What would you call it? Publication, I suppose. Publication, indeed. So yeah. I guess the idea behind this is, and this work goes so that the whole passive versus active debate, which is, the debate in finance that will never die, right? And you could argue that passive is gradually been winning that debate. And if you just look at the numbers, like the percentage of assets that are passively managed or managed by indices is just kind of gone up persistently over quite a long period of time now. So that seems like an argument that's been pretty much won. But one of the things related to that is, well, if you are going to invest in active managers, should you invest in ones that have done well recently, or should you, in other words, is performance something that is persistent? And that's kind of relates to it, right? Because if manager performance is persistent, has some signal. So there's two options, right? So one is that good managers continue to do well. The other is that good managers mean revert, right, and become less good managers or even bad managers. So to get technical for a second, if you look at the returns of a particular fund or a particular strategy, do those returns show positive autocorrelation? In other words, good performance follows good performance, or do they show negative autocorrelation, in which case bad performance follows good performance? So do managers have persistent skill, or is it just luck? Like, a manager does particularly well in 1 year, are they likely to continue doing well in the future? So apparently that's what this persistent scorecard talks about. So yeah, it's quite interesting because it sort of brought it to my attention. But this going to take a while to go into the debate, but basically someone did an analysis of this persistent scorecard, and the FT sort of said, well, this is a very poor analysis, but actually ultimately it doesn't really kind of settle the argument one way or the other. So it's not. I'd encourage people to read it because it's a very interesting article, and I think it's a particularly hot topic, as we will get to in a moment. Indeed. Sure.
All right, well, let's get to that moment now.
Yeah.
Because the last, or the second last question, we'll see if we get to the last one. But the next topic was very cryptic when you sent it to me. You said, "Oh, I've been having a really interesting conversation with a CTA manager. So tell me more."
Well, yeah. So earlier this week, I had lunch with a old friend who's also a CTA manager, and I'm not going to mention their name because I've not asked them if I can do this. So, and their employer might not necessarily be happy about it anyway, but they know who they are. So I knew, we sort of got to talking about the fact that performance has not been great. Obviously, as we said right at the top of the program, it's recovered a bit recently, but overall, it's not been great. And I knew performance was bad because normally, well, let's just put it this way. We split the bill, which, I think all things considered means that the economic situation in CTAs must be pretty bad, right? Whereas, I suppose if things get really, really bad, then I'd be expected to pay for the whole thing. But unfortunately, things haven't got quite that bad. Anyway, so we kind of got to this kind of eternal question, which is, has everything changed, or is this just a temporary period of poor performance? And I think this is, every time there's an inevitable poor performance in CTAs, and for that matter, in any kind of strategy, equity value, for example, any strategy that will go through long periods of underperformance or negative performance, inevitably, at some point, people are going to be asking that question. And I'm sure, Niels, it's a question that you've been asked many times as well. So I sort of sat down. I thought, well, okay, let's be systematic. Let's be quants about this. So ultimately, the answer to the question, has something changed or not? Well, we can waffle and say, well, Trump's changed everything, or more algo trading has changed everything, or we could say that just over time markets get more efficient and therefore there's less alpha to be collected. You can come up with all kinds of plausible reasons why things might have changed, but ultimately, if I was to say, let's just boil it down to a really simple problem. Let's suppose I'm an allocator of assets and I've got two options for my portfolio. Let's return to that earlier paper, the Fidelity paper. My two options are, I've got a 60-40 portfolio, okay, and I've got potential to put some trend following in there, okay. How should I do that portfolio optimization? the one answer is to say, well, you should just take all the data you have, 25, 30, 40. I don't know how long the trend index has been going, but obviously it's possible to create, to do something like oh my goodness, I can't believe I'm saying this. You could do a replication of the the trend index, which is something I don't normally advocate. But if you wanted to, for example, create a backfill trend index that goes back much further, then you can do that by replicating the trend index and then using underlying futures prices. So it's not a hard thing to do. But or you could just create your own trend index. It doesn't really matter, to be honest, as long as you've got something that's investable. So you take your, let's say you've got 50. My own back test goes back to 1970. So let's call it around 50 years. It's got 50 years of data. You just use the whole of the data and you treat all of that data equally. So you basically say, I think that, 2025 is just like 1975. It's just like 1985, just like 1995. So I'm saying things haven't changed. I'm saying that to do any kind of optimization, I want to use as much data as I possibly can. So I'm just going to use all of my data and I'm going to treat it all equally. So that's kind of the starting point. The question is whether that can be beaten by doing something else. So what kinds of things might you do if you genuinely think that the world has changed? Well, one thing you could do, of course, is arbitrarily say, I think the world changed 3 years ago, and I'm just going to use the last 3 years of data, or 1 year ago, or some period of time, and just say, right, that's what I'm going to do. I think the world's changed. And, if I use, say, the last if we go back, say, 2.5 years, then obviously we'll miss the outperformance of 2022. And that means your CTA allocation would go down significantly. Depending on your exact methodology, it might go to zero, but certainly be a lot lower than it would be in the kind of using the full 50-year span. And you kind of smugly say, well, I'm not putting any money into trend following because, I've done this incredibly sophisticated analysis, and this is what I've done, and this is great. Now, the problem is with that is you've done something that is not back testable, because you have essentially created an arbitrary point. I mean, it doesn't have to be arbitrary. You could come up with some logic for why you've chosen 2.5 years or 3 years or whatever. But you've been able to do something that you couldn't have done 3 years ago, which is to know 3 years ago that trend following performance in the next, not quite 3 years, but 2.5 years was going to be very poor. So you've effectively kind of polluted your so-called, rigorous testing with future information. So you actually need to do something that could be back testable. So you need to have some way, a testable way of identifying when the performance of a particular strategy, whether it be 60-40 or trend following or any other hedge fund strategy, is likely to go down in the future. And as we've discussed, people are really bad at that. And, that if people are really, really bad at that, it means it's probably going to be quite hard to find any kind of algorithm that's truly in sample. So, that's not being polluted with future information, or conditioning variable or something like that that's actually going to say, well, your performance in the future is going to be better or worse. And if you do look at things like persistence and autocorrelation of things like that, generally speaking, the effects aren't especially strong. And it's really, really hard to say, well, yes, given recent CTA performance, what CTA performance likely to be over, say, the next 12 months. It's really, really hard to do that. So the other thing you might do is say, well, you know what, I'm just going to take a much more simplistic approach, which is to say, rather than using the last 50 years of data, I'm only ever going to fit using the last 10 years of data, or the last 5 years of data, or the last 3 years of data, or the last 2 years of data. And that's sort of better, from the kind of point of view you're no longer cheating with future information. The problem is if you do that, what you'll find is that your performance will be really bad. Because generally speaking, the more data you have, the better it is for fitting an optimization. And there's kind of there's a degradation of out of sample performance as you reduce the size of the data you have available to you. So you can imagine if you just think really silly, which is do an optimization based on the last 10 days, you can see how that would be kind of crazy, because you'd be, well, even ignoring trading costs, because obviously you're going to be pulling your money in and out of funds non-stop and putting it in 60-40 and vice versa. Even ignoring trading costs, you're just going to have mostly noise. It's just going to be, at best, it's going to be something just really badly. So there's a degradation of performance, and it's sort of non-linear. So basically, using 50 years of data is good. It doesn't make a lot of difference if you use 40 or even 30 years of data, or even 20 years of data. But when you're getting down to the point where you're using the last 2 or 3 years of data because you think that something has changed in the last 3 years, and you test that, you find that it's not going to do anywhere near as well as just, sticking to your guns and essentially assuming you can use all the data that you can. So that's kind of the theoretical answer to the question. And I'd hoped after saying that they would pick up the bill, but they didn't. But anyway, that's life.
So I'm curious. I obviously didn't know how long the lunch was, but I'm curious, did you conclude anything about has the world changed? But let me preface this with the fact that what surprises me is when I hear this argument, which I do, as you rightly point out, I do that a lot over the years. Some things changed, and usually is when performance is less than the average and all of that stuff. But my answer to that is, well, the world is always changing. And if you look at, say, the company that I work with, we've been doing trend following for 51 years. Can you imagine going back to 1974 and think about how much has changed in that period of time? Yet the strategy continues to work. Now, clearly you need to adapt and you need to do research. So in that sense, I don't subscribe to the fact that you can just apply rules from the 70s today and expect necessarily the same outcome. But I think the strength of this particular strategy is that it is adaptable, and it has proven over many, many decades that it's capable of, over time, produce not necessarily the same returns, but that's because people forget that actually the volatility of these benchmarks that we compare has gone down significantly. In the paper I mentioned that we did at Dawn, we went back and looked at the rolling volatility of the Barclays CTA index, and back in the 70s and the 80s, it was, more than 25% annual volatility. Today, that index is less than 5% annualized volatility. So clearly, returns should be lower if you're just looking at those kind of overall stats without, looking into the stats. So, no, I actually think it's a fair question to ask, but I think we have a really good answer in our case.
Yeah, the issue is that if you think about a different kind of statistical testing, which essentially is if you sort of look at the sort of rolling performance of trend following over time and say, well, has that degraded? Visually, you can see some degradation, and I appreciate, you kind of have to volatility adjust in a sense, because the markets in the 1970s were a lot more volatile than they are now, particularly commodity markets. So even though we are risk targeting, we're trying to risk target over time to get the same level of risk, it's still going to be hard, particularly in the earlier days when there were fewer markets, there was less diversification. So that also made it harder to get a lower vol. But even if you sort of accept the argument that, it looks like returns are degraded, you still don't see a statistically significant difference in returns. And because it's quite a low sharp strategy anyway, it's going to take quite a long time, possibly even another 50 years, to know for sure that things have changed and it has definitely stopped working, quote unquote. So that's the kind of the, I said this before in a podcast and somebody picked it up on LinkedIn, but really you're at the point where statistics can't really help you. You either believe or you don't believe. The only thing I can say is that, people have been really bad at sort of timing investment in and out of strategies. And there's lots of evidence of that. So my kind of view is generally speaking, your starting point with anything should be buy and hold. Whether buy and hold underlying assets unless you're pretty sure you can, you've got a lot of confidence you can do better by trading them. And if you're investing in funds or strategies or risk factors, then again, you should be buying and holding those funds or strategies or risk factors unless you can prove very convincingly that you can do better. And all the evidence I've seen is that it's quite the opposite. People do a terrible job of timing.
Yeah, no, absolutely. Speaking of timing, Rob,
yes,
it's about 1 hour now.
I think it's a good time. We talked already about Fed independence, which was one of my final topics, so I think we can leave it there, yeah.
Yeah, no, absolutely. This was great to catch up with you. And thanks for all the articles you brought along and all of that. And of course, for all of you listening, if you want to send a little bit of love to Rob, why don't you go to your favorite podcast platform, leave a rating and review so that more people can join us when Rob and all the other great co-hosts are on the show. Speaking of great co-hosts, the next one next week that is joining me will be Andrew Beer. So definitely worth tuning into. I'm sure we'll have our usual interesting conversations, proper CTAs versus people who replicate CTAs, and that's always fun. And he's a good sport. And I know he's been publishing some stuff recently that will be probably good discussion points. If you have some questions for Andrew, which I hope you do, you can email them to info@toptradersunplugged.com, and I'll do my very best to make sure that we get them in our conversation. From Rob and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, as usual, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.